Yesterday, the spotlight of the global market was undoubtedly on Jerome Powell. He delivered his final keynote speech at the Jackson Hole Symposium and the markets went absolutely wild, but why exactly did they react so frenetically? What signals did Powell drop between the lines? And most importantly, did the market overreact? Yesterday was, without question, the liveliest trading day since April 2 end, Liberation Day, with every investor glued to Powell's remarks from Jackson Hole. His speech not only reflected the Fed's current view on the U.S. economy, but also hinted at the direction of monetary policy ahead. Whether September will bring a rate cut, a continued pause, or even another hike if inflation proves too sticky, all the clues, however subtle, are buried in Powell's words. And it's our job to decode them. Today, I'll walk you through a detailed breakdown of his address. Historically, the Fed's annual Jackson Hole gathering has served as a critical guidepost for future rate policy. The chair's speech often lays out the Fed's interpretation of macroeconomic conditions, providing the market with vital cues for expectations management. For example, back in 2022, when markets doubted the Fed's resolve on inflation, Powell doubled down, emphasizing the Fed's determination to fight price pressures and, sure enough, that September brought a 75 basis point hike. In 2023, his tone shifted away from hawkishness toward a more cautious stance, which was followed by 3 consecutive pauses. And last year, when Powell declared that it's time to adjust policy, it effectively launched the easing cycle. With the Fed slashing rates by 100 basis points over just 3 months. So what about this year? The challenges facing the Fed are arguably more daunting than ever: stubbornly high inflation, tariff effects rippling through trade, a cooling labor market, lingering uncertainty over growth, and on top of it all, Trump's occasional political interference. These overlapping pressures have weighed heavily on the 72-year-old Fed chair. As Nick DeMiros, widely regarded as the Fed's unofficial mouthpiece, has written, Powell is often jolted awake at night by the sheer weight of decisions that could impact millions of lives. Yesterday, that same man stood before us to deliver what would be his final Jackson Hole address as Fed chair. Now, let's dive in together and unpack the key takeaways from Powell's farewell performance at the central banker's most important stage. Right at the very start of his speech, Powell dropped a bombshell in pursuing the Fed's dual mandate of employment and inflation. The balance of risks appears to be shifting. This may require us to adjust our policy stance accordingly. The moment those words left his mouth, the market exploded. It was almost a replay of last year's script, Powell opening with an unexpected gift to investors. And the keyword here is adjust policy. Why is that so critical? Because right now, the Fed is operating under a restrictive policy stance. In this environment, any rate cuts are carried out with extreme caution and within a very narrow margin. The central priority remains containing inflation and preventing the economy from overheating. But Powell's mention of adjusting policy suggests something very different. That the Fed may be preparing to shift from a restrictive stance toward a neutral one and possibly even transition gradually into an accommodative stance. That shift would free the Fed from the current policy straitjacket, opening the door to meaningful, flexible rate cuts down the road. In short, Powell's words not only reshaped expectations for the upcoming September 17 FOMC meeting, but also broadened market imagination for the fourth quarter of this year and potentially all of next year. Then came Powell's remarks on the labor market, which gave us the second keyword of his speech. He said that overall, the labor market is balanced. But it's a peculiar kind of balance, one driven by a sharp slowdown in both labor demand and labor supply. So what does peculiar balance mean? Powell explained, businesses are cooling their hiring appetite, while fewer people are actively looking for jobs. The net result is a superficially stable unemployment rate that appears balanced, but in reality, it's an anomaly and a dangerous one. This signals that downside risks in the labor market are rising, and once this fragile equilibrium breaks, for instance, if companies move from simply slowing down hiring to outright layoffs, the unemployment rate could spike sharply, almost off a cliff. Powell's remarks essentially delivered one clear message to the market in the Fed's dual mandate of inflation and employment. The balance has begun to tilt toward the employment side over the past 2 years, with the labor market running hot. The Fed had the luxury of focusing all its firepower on fighting inflation without hesitation. But now, by explicitly pointing to the potential cliff-like downside risks in the job market, Powell is laying the groundwork for future rate cuts. In effect, he's saying, we cannot afford to wait until unemployment has already surged before taking action. Markets quickly interpreted this as a signal that even if inflation data shows some volatility in the months ahead, as long as the labor market remains in this fragile, peculiar balance, the Fed will be more inclined to ease, aiming to secure a soft landing for the broader economy. After addressing employment, Powell turned to inflation and tariffs. He noted that the impact of tariffs is largely a one-time boost to price levels, whereas monetary policy is focused on whether price increases create a sustained inflationary risk. That distinction introduced the third set of keywords from yesterday's speech: one-time versus persistent. This was the first time Powell clearly characterized the tariff impact as one-off. At the same time, he cautioned that while it's reasonable to treat tariffs as a one-time shock, the breadth and depth of their effects will take time to fully assess. His point was clear: if tariffs evolve into a persistent driver of inflation, the Fed will not sit idly by. Powell also emphasized that the White House's ever-shifting tariff policy could extend the timeline for price adjustments. Looking forward, he sketched out two possible inflation paths. The first, a wage price spiral leading to runaway inflation, but he downplayed that scenario, saying it's unlikely given the current peculiar balance in the labor market. The second, inflation expectations drift higher, pushing up realized inflation. He acknowledged this risk as more plausible. Still, Powell added a reassuring note for now. Both market-based measures and survey data suggest that long-term inflation expectations remain firmly anchored around the Fed's 2% target, with no signs of de-anchoring. Powell capped his speech with a forceful pledge: no matter what happens, the Fed will never allow a one-time price shock to morph into a sustained inflation problem. That single line carried three messages. First, it preserves maximum flexibility for the Fed if tariff effects spiral out of control. They can pivot back to a hawkish stance at any time. Second, it was a warning shot to the markets, essentially telling investors not to get overly euphoric. And third, it was a pointed reminder to Trump: you're free to push your trade agenda, but beware of the consequences. If those policies threaten America's inflation stability, the Fed won't hesitate to tighten, even if that means sacrificing economic growth in the process. Finally, Powell announced a revision to the Fed's policy framework, scrapping the average inflation targeting strategy that was designed back in 2020 to fight low inflation. In its place, the Fed is returning to a simpler, clearer long-term 2% inflation target that marks a pivot toward a more flexible policy regime. So, does this mean the Fed is really about to cut rates? And more importantly, what should you do with your stocks right now? Is this the time to buy or the time to get out? On the surface, rate cuts look like good news, but the reality is, the size of the cut, whether it's small, aggressive, or stretched over multiple meetings, will trigger very different market reactions, and yes, your portfolio will feel the impact. In today's video, I'll break down exactly how to interpret this market-moving signal, and I'll give you three key takeaways. 1. How to tell if this rate cut is an opportunity or a trap. 2. And most importantly, I'll share a powerful combo of technical indicators. This is a toolkit even professional investors monitor closely, and it can give you a sharper edge in reading the market, improving your decision-making and boosting your returns. 3. Which sectors are likely to be the real winners? But before we get there, let's answer the fundamental question: why does one Fed decision send shockwaves across global markets? Think of the Fed as the heartbeat of the global financial system. Every rate move changes the rhythm of global capital flows. When they cut rates, it's like changing the circulation speed of the world's economic bloodstream. And here's the key point that many investors still struggle with: is a rate cut bullish or bearish? The honest answer is it can be either. Let's start by looking at the bullish side of rate cuts. When the Fed lowers rates, borrowing costs for companies drop, especially for capital-intensive sectors like tech, where firms need constant funding for R&D for them. A rate cut is like the bank suddenly offering a discount on loans. At the same time, when savings account yields and CD rates fall, investors naturally shift their money into riskier but higher return assets, which often means equities. That's why rate cuts are usually a tailwind for stocks. But here's the catch: if the Fed is cutting because the economy is already in serious trouble, the story flips. In that case, a rate cut is like a doctor prescribing herbal medicine to a patient in critical condition. Sure, it's treatment, but it's also a sign the illness is severe. And that leads us to a key distinction I always highlight. Not all rate cuts are created equal. I break them down into two types: preventive cuts and recession cuts. Preventive cuts are like a healthy person taking vitamins to avoid a cold. The economy's fundamentals are sound. And the Fed is just fine-tuning policy to extend the cycle, what we often call a soft landing. Growth slows, but doesn't collapse, and monetary policy helps cushion the adjustment. Recession cuts, on the other hand, are like a doctor forced to treat a patient already in critical condition. The economy is in trouble, the Fed cuts rates to stop the bleeding, but usually it's too late to prevent a downturn. These are the cuts that often accompany bear markets, the hard landing scenario. So which one are we facing now? Let's look at the latest numbers. July's U.S. unemployment rate came in at 4.2%, inflation at 2.7%, still above the Fed's 2% target. The labor market remains relatively stable, but inflationary pressures haven't fully subsided. Put together, this looks much more like a preventive cut than a recession-driven one, but here's the real question: how will the market react? That's where technical analysis comes in, because monetary policy itself doesn't make you money or lose you money, the market's reaction does. Think of it like driving. You can't just rely on the turn signal from the car in front of you, you've got to read the road yourself. So let's look back at history. After previous rate cuts, did we see bull markets or bear markets? The answer is both, and that's why context matters. Take one success story. In 2020, during the pandemic, the Fed slashed rates to near zero and unleashed massive quantitative easing. What happened? Tech stocks exploded. The Nasdaq surged from 6,600 to over 16600, a gain of more than 140. The QQ ETF rocketed from around $160 to nearly $400, up 150%. That was a true once-in-a-decade windfall. But not every rate cut produces a rally like 2020. Take the 2008 financial crisis. The Fed also slashed rates aggressively. Yet the Dow still collapsed from 14,000 to around 6,500, a drop of more than 50. Same policy move, totally different outcome. Why? The difference was the market backdrop. In 2020, the shock was external, a pandemic. The underlying economy was structurally healthy, so policy stimulus had a strong impact. In 2008, the crisis was inside the financial system itself, a structural breakdown. Rate cuts couldn't fix that, and if you looked at the technicals, the divergence was clear. In 2020, easing was accompanied by surging volumes and improving breadth. In 2008, the opposite: weak internals despite policy support. That's why I always stress, it's not about what we think the market should do, it's about how the market actually responds. So which playbook applies today? The answer lies in technical analysis. When a rate cut hits the tape, I focus on three key indicators. These are the best gauges of what the market is really thinking. First, market breadth. Think of it as the market's thermometer. It measures the ratio of advancing stocks versus decliners. In a healthy rate cut reaction, you want broad participation. The tide lifts all boats, most stocks rally together. But if only a handful of mega caps are pushing higher while the majority lag or fall, that's a red flag. The rally may be a mirage. Second, trading volume. This one is critical. Real trends need volume confirmation. In March 2020, when the Fed unleashed unlimited QE, tech stocks didn't just jump in price, volumes exploded higher. That combo told me it wasn't just a rebound. It was the start of a new bull leg. Conversely, if stocks rise on shrinking volume, that's often a dead cat bounce. Strong rallies need strong money behind them, especially institutional flows. Third, the VIX, the so-called fear gauge. The VIX reflects expected volatility over the next 30 days. Rate cuts should normally calm nerves, pushing the VIX lower. But if the VIX spikes on a cut, that's a warning the market doubts policy effectiveness. And remember, rate cuts almost always trigger sector rotations. Understanding those rotations, who wins, who loses, is critical for making the right allocation decisions. Now let's use the latest price action to break down where the real sector opportunities are, from a technical analysis perspective. The key is to watch relative strength across sectors. Which sectors are breaking through resistance first? And where we see volume surging ahead of the curve, these are the early tells. Take real estate. this is one of the most direct beneficiaries of rate cuts. Since lower rates immediately filter through to mortgage costs, that's why REITs and homebuilders often lead in a rate cut cycle. We're already seeing it. Housing-related ETFs have rallied about 10% over the past month. A move that reflects both falling yield expectations and growing confidence in housing demand. Another standout is crypto and crypto miners. Bitcoin recently broke above the 120,000 CAD mark, clearing a major base pattern on the charts. That breakout, coupled with strong price volume confirmation, signals real momentum. Mining stocks, in particular, have been outperforming, with the rate cut narrative acting as a powerful tailwind. Gold is another sector that demands attention. Lower interest rates reduce the opportunity cost of holding gold, which doesn't generate yield, making it relatively more attractive. We're seeing this play out in both gold ETFs and gold mining stocks. After establishing a solid base, gold miners broke through a key resistance zone. Even during pullbacks, they've found strong support at technical levels. A clear sign that rate cut expectations are providing structural support to the entire precious metals complex. Now, let's put all of this together into a practical trading framework. Beyond sentiment and sector rotation, I rely on two core tools: price-volume analysis and trendline analysis. Price-volume relationship. A healthy uptrend requires rising prices with rising volume. If price rallies while volume contracts, that's often a false move. But when breakouts come on surging volume, especially with institutional flows behind it, that's when I pay attention. Trendline analysis. This is about gauging both direction and strength, following a rate cut announcement. I look for stocks to either break above a long-term downtrend line or establish steady momentum within an upward channel. Look back at Tesla in 2020. During the Fed's easing cycle, the stock delivered a textbook breakout. It pierced through its long-term downtrend. Volume spiked week after week, and candlestick patterns flashed reversal signals. That trifecta confirmed the start of a new uptrend. Finally, a reminder: no matter how strong the setup, risk management is non-negotiable. I approach it in 3 layers. First, always set stop losses just below critical support, whether that's a trend line, a prior low, or the bottom of a channel. If those levels break, the technical picture has changed, and discipline requires cutting losses quickly. The second layer of risk management is position sizing. Even if I'm bullish on the impact of rate cuts, I never go all in at once. Instead, I scale in gradually, adjusting my exposure based on the strength of technical signals. The third layer is market sentiment monitoring. If breadth suddenly deteriorates, or we start seeing frequent distribution days, I'll trim positions even if the fundamentals haven't changed. The golden rule is this: protecting gains is just as important as making them. So let's wrap this up with 5 key takeaways from today's discussion. First, a rate cut isn't automatically bullish or bearish. It all depends on how the market interprets it. And remember, there are 2 types of cuts: preventive and recessionary. The latest move looks more like a preventive cut, but the market's reaction will always hinge on multiple factors. Second, keep an eye on market sentiment indicators, things like volume trends and the VIX. These give you a real-time read on how investors are processing Fed policy. Third, pay attention to sector rotation. Real estate, gold, and crypto are the prime beneficiaries of rate cut expectations. But technical confirmation is essential before committing capital. Fourth, make full use of price-volume analysis and trendline confirmation. A sustainable uptrend requires expanding volume, and when prices break through long-term resistance levels, that's often the signal of a new trend taking shape. Fifth, and most important, always practice disciplined risk management. Set stops at technical support levels. Build positions gradually and constantly monitor shifts in market sentiment. If you internalize these 5 points, you'll be much better positioned to make informed decisions and capture real opportunities in a rate cut environment. That's it for today's video. If this breakdown helped clarify the investment logic behind rate cuts, do me a favor, hit the like button, share it with a friend, and make sure you subscribe and ring the notification bell so you never miss an update. And I want to hear from you. What's your biggest concern about this rate cut? Which stocks in your portfolio do you think could benefit the most? Drop a comment below. I read them all. Thanks for watching, and I'll see you in the next one.